All right. Good afternoon. Good afternoon. Good afternoon. There's a lot of news flying around right now. We've just heard that the Bank of England are increasing the Bank of England base rate from 1.25% to 1.75%. This is going to be the biggest rise that we've seen, I think, in about 27 years, roughly. So, what I wanted to do is just provide a little bit of information, some thoughts around the news, what it basically means for consumers, for borrowers, for savers. I'm also going to go through some numbers that I found online around what the mortgage market is looking at right now, and how the mortgage market is comparing to consumer debt and the numbers we're seeing there. I'll also talk about one of the biggest things that we're finding from the announcement, and that is the fact that inflation is now forecast to hit 13%, which is a huge number. And a large proponent of that is because of the energy price increases that we have seen. I know that someone in the comments is already asking, what does that mean for us if we're investing in the stock market? I'll also cover that. So there is quite a bit to cover in this. If you do have questions, use the chat or the comment section to leave questions. I will answer those. If you are new to my channel, I am a qualified financial advisor, qualified mortgage advisor. I worked 15 years in financial services across retail banking, corporate banking, wealth management. So I bring a little bit of experience to this kind of conversation. So hopefully this will be useful. But let's get started with the news itself. Now, what we do know, and I'll be sharing my screen through this, is if you don't know anything about the Bank of England, the Bank of England has something called the Monetary Policy Committee. There are 9 members altogether, and it was an 8-1 unanimous decision to increase the bank rate by 0.5%. Now, that is actually quite significant because all of the prior 5 interest rate increases that we've seen earlier this year were small increases by a quarter of a percent, so 0.25%. This is the first time this year that we've seen the Bank of England move at a 0.5% increment. And whether that signposts what is to come down the line, we don't know just yet. But I think there is a lot to be said for the fact that they are already signposting the fact that inflation is going to hit 13%. And that's why they voted to move by a 0.5% increment in opposed to a 0.25% increase. Now, what does that actually mean? If you are on a standard variable rate or a tracker mortgage, what will essentially happen is that you will see your interest rate move accordingly. Now, if the interest rates are increased by 0.25%, you're going to see a smaller increase than 0.5%. So I've been saying this for months. If you're in a standard variable mortgage or in a tracker mortgage, you need to be thinking about getting into a fixed rate, because I don't think that they're done when it comes to interest rate rises, particularly with the inflation number being forecast at 13% now. So this is where you need to be speaking to your mortgage provider, a mortgage broker of some kind, to try and see whether you can fix your mortgage if you have one. This is just a little something from the Bank of England Twitter account, which I'm just going to share with you now. And this is just a tweet that they put out a little bit earlier on. The Monetary Policy Committee voted by a majority of 8-1 to increase the bank rate to 1.75%. And it also gives a bit of a visual here where it says, the main reason why they've pushed this far with the increment is because of inflation expected to push 13%. And it also says here, we know that the cost of living squeeze is difficult for many people. We put up interest rates to bring inflation back to our 2% target. Now, for the longest time since the beginning of this year, in fact, a lot of people have been, arguing and questioning whether a 2% target for inflation is still realistic based on where we are right now. That is a question that's going to have to be answered way down the line. Because at this point in time, 13%, we're at 9.4%. If we hit 13% by the end of the year, is it going to be realistic that we're going to hit 2% in the next 2-3 years? I personally cannot see how they're going to do that. But what I do want to share with you is just some comments from Faisal Hislam. So its commentary today on the BBC website is actually really, really interesting. So he's the BBC's economics editor. So I'm just going to go through this with you. It goes, the bank's prediction of a recession as long as the great financial crisis and as deep as that's seen in the early 90s is the big shock here. So what with the 13% inflation, it is what they're forecasting is going to tip us into a recession by the end of this year. And what he's basically saying is that what is being forecast is quite staggering. The bank thinks energy bills hitting nearly £300 per month on average, treble their level of a year before, will plunge the economy into the final quarter of this year into a recession. If global energy costs remain where they are, that recession will then last the whole of next year, with inflation barely below 10%, even in a year's time. So, again, going back to that 2% target, it's unrealistic at this point in time. Will they be having conversations about how they move that? I don't know. They probably will be. But in order for inflation to get back to that 2% level, interest rates will have to rise significantly higher than where we are right now at 1.75%. By what magnitude? I don't know. I'm not really an economist, but it doesn't stack up. We cannot have inflation heading towards 13% with an interest rate of 1.75 and expect things are going to level out back down to 2%. There will need to be further action in here. Um, he's saying here this is a full fat recession now being predicted by the Bank of England, at the same time as a 42-year high in the rate of inflation. It's a textbook example of the combination of stagflation of the economy and high inflation. So stagflation. And funny enough, on my channel, I actually made a video. I'm just going to see if I can actually find it. Go and watch that video. I actually talk about stagflation and how it's a really, really difficult equation to get out of. It's this video right here, the state of stagflation. Rishi Sunak is on the thumbnail for this, but it's really, really important. It's a difficult situation that we find ourselves in right now. Unsustainable, yes, 100%. But what is this going to mean for lenders and consumers? I was looking around a little bit earlier on today, and I found this really interesting article around the state of the property market and and how mortgage lending has actually fallen. Now, if you're looking to buy a property, that's a good thing because as I guess the demand for properties fall with less mortgages being written, house prices should come down. However, where I live in Shropshire, I'm seeing how prices still go up. So the funny thing about the contrast here is, whilst we are seeing mortgage numbers start to taper off, consumer debt is actually going up. And I'll share some numbers with you in a moment. And this is another thing that I think is really important to highlight on this live. If you are using credit cards, so on and so forth, credit cards aren't necessarily tied to the Bank of England base rate. So you don't necessarily see an automatic or an immediate impact on your credit card rates. But the banks and the lenders can choose to increase the rates if they want to. Now, if you do have a credit card, I would strongly advise you to pay attention to your credit card emails or your letters, any form of communications from your credit card providers in the next 30 days. Because if they do decide to increase their rates, then they have to give you notice. Now, if you get into a position where you get a note from your credit card provider and they want to increase the rates, you don't have to accept that rate. Now, there is a catch with this. What you would have to do is you'd have to either go and source a 0% balance transfer, try and transfer the debt out to something where you're not paying the interest, find the best deal that is available to you at that point in time, or you could just pay down the balance of that credit card on the existing rate before it moves on to something higher. Now, look, the debt conversation and how people manage debt is one of a separate conversation to have. But I mean, it's a really, really difficult time because look, we're seeing an environment where energy prices are going up, right? And a lot of people, when they're struggling, will go to things like overdrafts and credit cards and credit facilities. And let me just show you these numbers actually, because it will paint the picture a lot better than me just kind of reeling it off. So this is actually on Yahoo Finance. This is back in July. So this is the end of July. So only a few days ago, it was saying mortgage lending plummets and consumer borrowing basically soars. I will link all of this in the comments if you want to go and check this out. So just to provide some context, the UK mortgage lending decreased to 5.3 billion in June, down from 8 billion the month before, as consumer borrowing rose during the month, new data was shown. Now, it gives a little bit of context around the fact that if you look at 12-month periods, the pre-pandemic averages were kind of okay-ish, but this is where you start getting into the detail right here. So let me see if I can find the right section. One second. So gross lending decreased to 25.4 billion in June from 28.1 billion in May. So this is lending on mortgages, right? So how many mortgages are being written, how many mortgages are actually being approved. So there's a reduction in there. And gross repayments decreased slightly to 20.3 billion from 21.2 billion. Approval of house purchases, an indicator of future borrowing, decreased to 63,700 last month from 65,700. So a 2,000 decline between June and May, which is below the 12-month pre-pandemic average up to February 2020 of 66,700. Now, approvals of remortgaging. So people looking to remortgage their properties, which only captures between different lenders. So if you're, for example, with Barclays and you remortgage with Barclays, it doesn't take that into consideration. It only takes into consideration if you're with Barclays, you're remortgaging with Halifax. Even that saw a decrease to 44,000 in June, down from 47,200 in May. This also remains below the 12-month pre-pandemic average up to February 2020 of 49,500. Now, you've got to come all the way down here before you actually start getting into the consumer credit borrowing section. So it comes as consumers borrowed an additional 1.8 billion in consumer credit on net during the month. That's in June, by the way. The additional consumer credit borrowing in June was split between 1 billion on credit cards and 800 million through other forms of credit, such as car dealerships, car finance, personal loans, so on and so forth. So £1 billion increase in credit card usage. And let me just put this into context, guys, because at the end of the day, it feels as though we're at the beginnings of what is going to be a very, very tight situation for the nation. We've only seen one price increase, and that is the one from April. We're struggling with that. We know that another price increase is coming in October. And if you've been paying attention to the news, Ofgem just announced that the price cap is going to be announced every 3 months. Every intervention that we've had thus far only takes into consideration price cap increases for April and October. So the £400 that everybody gets is designed to cover that period, those increases between April and October. What we don't know is what's going to happen to the price caps past October. So if the cap prices are going to be increasing every 3 months, well, you're going to hit January, possibly have an increase in there. April, possibly have an increase in there as well. The reality of it is, unless something happens with Russia, something happens with our energy supply, this could escalate and spiral drastically. And what we're seeing here is if people are already borrowing an additional £1 billion in consumer credit, this is going to be extremely painful to deal with. I can't say that I have all the answers because I don't. But one thing I am encouraging people to do is be extremely proactive. If you are struggling, on the podcast this week, I spoke to Turn to Us, which is basically a charity. They are helping people actively deal with the cost of living crisis. Again, I will link down below the conversation to the podcast and maybe some of the links that they provided me there. It is a free service. If you are struggling, you need to be thinking now. We are currently in summer months where we can afford to use less gas, use less energy. But as we hit October and start to get into the late weeks of October, beginning of November, things are going to get colder. The temperature is going to drop. That choice of being able to ration, I guess, our gas usage is going to be taken away. So please be proactive with this. In terms of the inflation numbers being at 13%, the largest proponent of that is going to be energy prices. And they are already taking into consideration the increases in October. As I've already said, the price cap is going to be reviewed every 3 months. If we see increases in January, increases in April, it is very, very possible that that inflation number is going to be a lot higher than what they're forecasting now at 13%. It could be 15%. What I'm trying to say here is we're in a very, very we're in for a very rough ride. Really, really rough ride. So please be proactive. Please seek help. I did a video this Tuesday talking about the Don't Pay UK movement. And I think a lot of people got what I was trying to say completely wrong here. At the end of the day, I am not your mum, your dad. You're going to do whatever you feel is right for you. If you want to go join the movement, 100% go do that if you feel that is right for you. However, I highlighted 5 key things that you need to know. And I think that there are more fruitful things that you can do before you get to the stage of doing something like that. You need to be informed. And that's my job. That's my job is to essentially inform you guys of what I think based on my professional opinion and my knowledge of the industry. I'm here to help people make the best financial decisions possible, not make irrational decisions that may harm you a little bit later on. And I think it's really important at this junction for me to say this, right? Everybody is dealing with this in a separate and in a different way. There seems to be this assumption that if you have a mortgage, this isn't going to be touching you. I know a lot of people who have mortgages who are struggling with this right now, who are petrified of being able to make ends meet. Same as other people who maybe don't have mortgages right now. I completely understand that there is a spectrum here, and it doesn't matter what scale you are on the spectrum. The important thing is to be able to make an informed decision based on, I hope, good information that I'm actually giving you. A lot of it is based on what I know, based on what I find. I'm interpreting stuff, trying to give you my opinion, but ultimately the choice is down to you. Now, what does this actually say for the markets? Because I think this is really, really important. I'm just looking at, let me just share this with you, looking at the global markets today. We're in a rare position where we see green all the way through. I mean, if you look at the S&P 500, it's up 1.5%, NASDAQ 2.59%, FTSE, the S&P 500 0.36%. If we get to our domestic, the FTSE 100 is up 0.5% at this point in time. I mean, the pound was up today because of the news that interest rates were going to be moving. And I think that's a byproduct of simply knowing that the Bank of England are taking action to address this. What does it mean for the markets long term? The whole idea of increasing interest rates is to essentially discourage spending and get people to save more. So for savers, you're going to see this interest rate hike benefit you, but it's not going to be anywhere near the levels that you need in order to keep up with inflation. We're in a really unique situation right now that where inflation is so high, and a lot of that is because of energy bills. You're stuck. You're really, really stuck. So, guys, I don't know what this is going to mean for the markets. I'll be very, very surprised if we end up the year with the markets being in green. I think if you're investing right now, I made a video a couple of weeks ago. I think it will be which one would it be? Let me just show you. I think it was, which video was it? This video would be a good one to watch. I compare the FTSE 100 and the S&P 500. Again, please don't misconstrue what I say in that video. The main lesson in that video is about diversification and making sure that you have a good diversified plan for all of your investments within that. Go and have a look at that. There are some lessons in there. Again, you need to interpret that information and see how you implement it into your own investment strategy. If you need me for help, I do one-on-one coaching, so you can also talk to me about that as well. But guys, it is a very, very difficult position to be in right now. I know that there are a ton of questions, so let me just see if I can get to the chat very quickly and maybe take some of these as well before I nod off this afternoon. Spencer's saying here, let me just get this up. My mortgage has come to an end. The bank has sent out emails saying that I can jump back into a new deal, but I'm overpaying by £600 a month. If I was to jump into a new deal, I'll have to go back to old payments, or it'll included of your interest rates. So I mean, look, I think at the end of the day, mate, you've got to do what you feel is right for you. If you're on a standard variable rate, I mean, when you say your deal was ended, so I imagine you're in a fixed rate deal, so you're on a standard variable rate right now. You need to weigh up the odds, mate. If you're overpaying £600 a month as well, in times like this, I want to make sure that you are actually using it to reduce your term and it's not going towards interest. that will be a conversation to have with your bank. There was maybe have a look at downloading an app called Sprive. It's Sprive. The founder of Sprive was on my podcast maybe a couple of months ago, and Sprive is all about helping you pay down your mortgage in the quickest time possible. So where you're making £600 overpayments on a monthly basis, that might be something that was worthwhile looking at, just to give you a little bit more structure around what you're doing. Kiki, let's have a look at your comment here. So it should be 71% and now is 150%. Price to sell ratio historical should be 1 and now 2.3. 10 years PE ratio should be 16 and now. My opinion is that stock market is going to go minus 50. It is quite possible. I mean, look, you can't have these kind of monetary policies being put out there to encourage people to spend less and save more. Typically, when that happens, markets take a tank, because if we were in normal circumstances where you didn't have high inflation, it would mean that the money that you had in the stock market, well, you could get better returns in a savings account, because technically, why would you take the risk on the stock market if you could get a really decent rate of return in a savings account without any risk? That's how it should work traditionally. But one thing we've certainly learned over the last maybe even 10 years is that things don't tend to correlate or work as they normally should anymore. But I do think that there's still quite a bit of room for the market to fall. And if you are invested, you've got to be prepared for that at the end of the day. You have to be. I'm just going to scroll some of these. Good man. Spencer's saying he just used the mortgage calculator to put a smile on your face. Good. Video to view. Thank you. Let's have a look at this. I just want to say thanks for your advice. I've been watching your videos for a while and just bought my first house using my and my partner's lifetime ISA. Dude, that makes me happy. That's the reason why I do this stuff. So I'm glad that it's actually helped massively. You do have a follow-on comment in here. What are your thoughts about solar panels? I'm thinking of investing in a self-sufficient system that's just enough for my needs. You know what? It's a funny thing about solar panels. Some people say that actually it won't make that much of a difference here in the UK because our supply of sun. And people obviously talk about whether you have a way to actually store the energy. So you can collect it, you can store it, then use it a little bit later on. I don't necessarily have a particular opinion on it. You would need to do the numbers to see if it works out. A lot of this stuff is quite expensive to put in place. Is there a little bit of help? Can you get grants towards that? I'll look towards that as well. But the numbers, as far as I've seen people speak about them, sometimes it doesn't stack up because we don't have a great supply of solar energy here in the UK as a pure function of our weather, essentially. So, yeah. Do you think it's a good time to buy a house or a car? Look, property. I would watch the property market. If the mortgage rates continue to dwindle, you would assume that house prices should fall. So potentially there's an opportunity to wait and see what happens with the property market, and that will help you. I mean, it's a weird balancing act, right? Because on one side you might have property prices fall, but the mortgage rates are increasing. So are you actually getting the benefit of the property price reduction when mortgage rates are going to be higher? But I would watch the market for sure. As for buying a car, if interest rates are going up, you probably want to get in early, because I think there will be more interest rate rises coming along. And I think the Bank of England will signpost a lot of this anyway. But yeah, you've got to make a decision based on what your circumstances are now. If you can afford it, then by all means do it. But there is also an argument for keeping money back and trying to reserve money. So, again, it's a very, very personal decision. Yeah, saying the position you're looking at is 8,150 would pay for itself in about 13 to 14 years if the price stays. Okay. Yeah, well, the question is the price going to stay at that level? Who knows? Yeah, who knows? But I mean, look, do the maths and see what you think. If it sounds like I mean, because the other thing to consider with this is it a good long-term investment? Is it going to help you in the long term? So we can definitely put a microscope under the now because of the circumstances we're in, but does it add value in 5, 6, 10, 14 years time, like you're saying there? If it does, then could be a really good decision. Anyway, guys, thank you so much for joining me. I know this has been a little bit longer than I thought it was going to be, but hopefully some of this stuff has been useful. I will link a load of stuff in the comment. I'll pin a comment with a load of links for you to go and check out. But if you have any questions, leave them in the comments. And yeah, I'll catch you later on. Cheers.